Okay, we are 6:32 Central Standard Time, so I'm going to start. What I do want to mention first, before we get into anything, is for those of you that are attending, thank you very much. I know that you are taking time out of your busy schedule. You're raising families, you're running businesses, you have jobs, you have passions. So my intention for today is to just, in about 45 minutes, be able to provide some basic concepts when it comes to financial planning, because unfortunately, they don't teach this stuff in school. It'll be about 45 minutes, and then I do have my friend Matt in the back that's going to be, I would say, gathering the Q&As for later. So if you do have questions, there is going to be a Q&A chat box where you can put your questions in there, and then I'm going to be answering them later. Okay. Now, before we do get into it, I know that we have people on the webinar that don't know anything about me. So a little bit about me is that 6 years ago, I didn't know anything. 6 or 7, I didn't know anything when it came to finances. I probably couldn't even spell TFSA at the time. I was a sheet metal worker. You can see that was one of some of the work I did about in the bottom right corner there. Um, I took a year off because I wanted to become a firefighter. And then I used those qualifications to then apply for the Army, where I was a medic in the Army Reserves. I did that for about 7 years. And since I was a reservist, I was doing full-time work and I was doing part-time work. And I kind of bounced back and forth from the trades. And I was making some pretty decent money at the time. But what I found is that I had no idea what I was doing with it. And it just seemed like no matter how hard I worked, I really could just not get ahead. So in 2020, I ended up getting my license. And it wasn't to like build a business, it wasn't to help others. It was actually to teach myself this stuff. I didn't even know that you can even hire a financial advisor. So honestly, it was more of a selfish decision. And then the pandemic happened. I got laid off from the trades. All the job sites were shutting down. So then what I did is I took a deployment with the military to assist patients with COVID-19 at the time. And what I did is I worked enough part-time where then after that deployment, I then left the military and decided to pursue this business full-time. I then incorporated A&E Financial Services in April of 2023, I believe. And I've been off and running ever since. It might have been I think might have been April 2022. As you can see in my spare time, I am a purple belt in Brazilian Jiu-Jitsu, where you can see in the military photo, there's a little bit of a cauliflower ear there. And yes, that is the best attempt that I have at growing a mustache. I was up for about 2 or 3 days when I took that photo as well. That's my coach. That's my professor, Tino. And in the summer, I do like to focus on my golf game, where I am blessed to have the opportunity where I did win the 2020, 2024, and 2025 Manitoba Mid-Amateur, and I've been able to represent Team Manitoba on 4 Wellington Cup teams. And last but not least, save the best for last. That is I would say that is my smoking hot fiance right there. And we are having our first baby in January, and we're going to be talking about how you can set up kids for the future. So whether you're in a small town, whether you're in a big city, I'm sure that you can walk down any street and you're most likely going to find a bank, a credit union, an insurance company, an investment firm. So with so many financial products being sold, isn't it a little odd to know how little people know about finances? When I started getting my license and I started helping people, I soon realized that it wasn't just me that didn't know anything when it came to finances. It was majority of Canadians. And what I found is that majority of Canadians are struggling to find the basic answers when it comes to retirement, when it comes to insurance, or even just how to properly eliminate debt. And what I found is that it leads to a lot of confusion, frustration, and marital disputes. I believe the third leading cause of divorces are because of finances. And what I also noticed with about a year of having a license is that there's a vast difference between what the middle class are taught about money and what the wealthy were taught about money. And I also noticed a difference in the service. So I started thinking, what if I could provide a service that I wish I would have got when I was at one of the big banks? So instead of becoming an employee at one of the big banks, I said, why don't I just go on my own, incorporate my own business, be a broker. And then that way, when I put these financial plans together, I can shop around and find the best deal for my clients. And then in return, it's the companies that will compensate me. Okay. Now, when we look at how Canada is doing, it's about 85% of Canadians are living paycheck to paycheck. 40% of Canadians are pulling from their RSPs, which is fully taxed. The average consumer debt is about $22,000. 42% of Canadians do not have any individual life insurance because they rely on their stuff through work. 45% of women and 50% of men will be diagnosed with some form of cancer in their lifetime, and the total Canadian household debt right now is a little over $3 trillion. So what I want to do is teach the basics, right? Like I said, I play a lot of golf. Finances is just like the golf swing. You got to keep it simple, okay? So what I teach is the 6 steps to financial independence. If you follow these 6 steps, you're going to be just fine. And step 1 is it's all about cash flow. You can't be getting a plan done if there's no money coming in. So it's all about what is coming in versus what is going out. Okay. And what I see right now in our society is we are living in a very consumer-based society right now. It's all about spend, spend, and spend. We're trying to keep up with the Joneses. I hear a lot of people and they say, you know what? We're probably entering a recession soon. I don't see it. I go to the airports, they're packed. I go to the malls, they're completely packed. And what I find pretty unique is typically with the Jewish community, they earn $1 and they spend 80 cents. For the majority of us, we earn $1 and then we go spend $2, right? So I think it's because of social media right now. We are trying to impress people that at the end of the day, they're probably bad mouthing us behind our backs, right? I can teach you all these techniques, but if you can't control your cash flow, this stuff doesn't work. I've met with a lot of people that even make $250,000 a year and they can't keep it. So I provide a monthly tracker for my clients and they can go back 30 days on their online banking and they can track everything they spent their money on. And it is very eye-opening, but it's a great tool to do every now and then. Usually when a family does a tracker, they can usually save $400 when it comes to careless spending habits. That's dining out, that is coffees every single day, that's online shopping, and that's maybe even subscriptions that you might not be using anymore. Step 2 is cash flow protection. And most people say, you know what, Al, I'm good. I'm covered through work. Okay, sweet. How much do you have? Not a lot of people know. So when it comes to life insurance, you will typically have 1 to 2 times your annual income. Okay, that's about it. So if you have $300,000 owing on your mortgage and you're making 100 grand a year, can you see the shortfall already? Right. And when I ask people, what is a Canadian's largest financial asset? What do you think they say? They mention their house. Okay, sweet. So if you can sell your house, how much do you think that you can get for it? And they say, you know what, Al, I can get maybe $500,000 for my house. Okay, sweet. And you're making 80 grand a year? Yeah, okay. So then for the next 20 years, your wife, your husband, your kids, they're going to be relying on you to bring home $1.6 million. It's not factoring inflation. It's not factoring any pay raises you may experience. And if something happens to you, like a disability or a critical illness, and you can't work, completely take this out, how are you going to afford your house? So your house is not your largest asset. It is your ability to work your 9 to 5. And what I see right now is a lot of Canadians, they're essentially uh, playing with a pulled goalie when it comes to their finances. They're all on the offense, and it just takes one turnover. Okay. Now, step 3 is going to be debt management. Okay. When you are in debt, right, you are essentially telling a business or an individual is that, okay, you're going to own my time or you're going to own my labor for the next 3 to 5 years, let's say. Okay. Where savings is the opposite. You're saying in the future, I'm going to have this tool of money that I can use to buy back my time. I can buy my future. Okay. And that would be savings. Okay. So if someone is in debt, you can incorporate something called the snowball effect. Okay, you can. I'm not going to explain that today, but there's a lot of calculators out there. And if someone's in debt, if you have equity in your house, you can essentially use your house and use that as collateral for a loan. You consolidate all those debts, put it into the mortgage, and even if you do have a higher interest rate, you can essentially be saving a lot of money in cash flow if you're putting all the credit cards, the lines of credits, and the loans into the equity of the house. Okay. So that is a technique. Step 4 would be emergency funds. This is typically where you need 3 to 6 months of expenses saved up because it's not if life happens, it's when life happens, right? It's when your car needs maintenance. It is when your roof leaks, your furnace goes. Because what do you think most people do when emergencies come up? They go back a step. They go put it on their credit card at 20 to 25% interest, right? So again, I see it on social media. They're like, you don't need savings. You should be investing all your money. Who needs savings, right? I mean, maybe, but you want to be stressed, right? You need to have cash. I think we kind of saw during the pandemic that cash is still king. You want to have confidence when you walk in a room, have cash. You want to be able to call the shots, have cash. You want to be able to take advantage of an asset and get a really good deal because you have cash, right? Um, everyone will say, everyone's asking me about real estate right now. I believe it's a great asset class. I don't believe it is the only asset class. So keeping in mind that you make your money on the buy. I hear a lot of people saying, well, I can just spend whatever because it's an appreciating asset. You make your money on the buy. And if you have cash, you can leverage that and get a better deal. And keep in mind, for the flippers out there, you're only one bad flip away from going back into debt, which is why we need cash. Okay. If you are entering your retirement, if you're 5 years away, you're kind of planning for the decumulation phase of your retirement, I will encourage 1 to 2 years of cash flow. Okay. There's a 2008, there's a pandemic. We all know what happened to the markets in 2020. You have money to ride it out. Okay. Because if you were to decumulate your assets when the markets drop, right, you're essentially just compounding that decumulation, right? And then it might have taken us some time, but hey, we got there. We can finally start building wealth. Okay. So if you're making $75,000 a year, do you know how much you need to have saved in order just to have the same standard of living? Right. You know, this ain't factoring any fancy trips, just on the same standard of living. You're going to need, because the data shows you need about 2.5 million bucks after taxes. Okay. So how do we know that? Well, at $2.5 million and you're going to earn a 4% rate of return in the markets, you can essentially have the same standard of living. Okay. So for people that say, well, I have money in an RSP or I have money in a pension, you haven't paid your taxes on that yet. Okay. So you need $2.5 million after taxes. And you have to ask yourself, are you on track to do this? Because what I see right now with the numbers is we're going to be entering most likely a retirement epidemic. Okay. They keep going back on whether they're going to extend OAS to CPP. Okay. And then step 6 is preserving the wealth. When we're going to be building it, I'm sure we're going to want to be preserving it. So, do Canadians have a will? 50% of Canadians have a will. I'll take that back. Everybody has a will. The question is, do you want it to be under government legislation or do you want it to be under your own? Okay, so there's a POA, power of attorney, and a healthcare directive. And it's very important that you follow these 6 steps in order. You know how many times I see an individual that is all gung-ho on building wealth. Meanwhile, they are spending $800 on dining out. They're all gung-ho on building wealth, and then they have a disability or they have a heart attack and they have to withdraw money from their RSPs that are fully taxed because they were either uninsurable, they were either too cheap, or they just did not know that they could protect their income. How many people that are focusing on putting money in their TFSAs and RSPs knowing they have credit card debt at 20 to 25%, right? Emergencies happen and they're all gung-ho on building wealth. And again, you have to withdraw from your TFSAs and your RSPs to be able to fund the emergency because you don't want to go back here, right? And again, people are all gung-ho on building wealth, but they don't even know that they could be leaving half of it to the government. Okay, so it's very important to follow these 6 steps in order and make sure you build a strong foundation. Okay, the power of compound interest. What is the rule of 72? I find it very interesting that I was taught calculus, I was taught algebra, BEDMAS, physics, and I didn't even know how my money could double. All right, so it's a very simple formula. You just take 72, you divide it by the interest rate that you're earning in the markets, the rate of return, and that's going to be the amount of years it will take for your money to double. Okay, so example, 72 divided by 4 means your money would compound every 18 years. So it would take 18 years for your 10,000 to turn to 20,000. If you're earning 6% in the market, 72 divided by 6 means your money would be doubling every 12 years. So again, look, we can get one more doubling period there. For 72 divided by 8, okay, our money's compounding every 9 years. One more doubling period, okay? And for an example purpose, I would never illustrate this, but for 12%, your money would be doubling every 6 years, okay? I would say the last 100 years, stock's been averaging about 11%, okay? But the question is, do you have the risk tolerance for it? One thing to note as well is there's something called inflation. What is inflation? Inflation is just the cost of living over time. That's why our grandparents could buy a can of Coke for 5 cents and now it's $3. Okay. So if inflation, let's say, is averaging 3%, well, 72 divided by 3 would equal 24. So it's going to take 24 years for your lifestyle to double. So we need to prep for that when it comes to retirement. It's the silent tax, right? So a 20-year-old starting with $10,000 and they're going to put away about $200 bi-weekly at an 8% rate of return, okay, until they're 65, they're going to have about 1.6 million bucks. If they come back to me when they're 30 and they want to do the same thing, then they're going to have about 713 bucks. 713,000. Okay. So you can see if you're young on this webinar right now, you have time on your side. Okay. Now, when you are building a house, where do we typically start? We start at the foundation. Okay. We talked about this. So now we can start building the walls, right? And out of a scale from 1 to 10, how well do you know these investment vehicles here? Because we can put money, there's real estate, okay? Your primary residence, you would not pay taxes on, but keep in mind that if you want to get into the rentals, okay, you would have to pay capital gains tax once you sell the property, okay? You could essentially, if you want to generate more cash flow, you could essentially look for a better interest rate right now. Probably can't find it right now, but during COVID, essentially for sure. And for people that are getting ready to buy their first house, follow these 4 things. Number 1 is you need to have, don't be house broke. You need to have an emergency fund. Okay. So you need those 3 to 6 months. You don't want to be house broke. I would keep it around 36% of your monthly gross income. People say, should I put 5% down? Should I put 20% down? I think you should be in the position to do both. And then you can weigh out the economical times. What are your goals, right? Because everyone's goals are different. And the other one is, can you see yourself living in the property for at least 10 years? If those are all yeses, buy the house. I would not buy the house because interest rates are high. Because you need to marry the house, you need to date the interest rate. You can always refinance. Okay. Now, um, and I also mention is when you do buy the house, the banks are going to offer you something called mortgage insurance. And we're going to explain why essentially we should be doing something else other than mortgage insurance. There is something called an RRSP. What does it stand for? A Registered Retirement Savings Plan. What are the benefits? Well, we get to put money in this envelope. Just consider these envelopes that you can put your money in. Then the government is going to reward you and you're going to get a tax deduction. Sweet. We're going to save some money on tax. Awesome. But you're just saving it for later. Okay. It's tax deferred. And when you take it out, you're going to be fully taxed. Okay. Contributions are 18% of the previous year's income. So if you make 100 grand a year, you can put in $18,000. If you don't know your RSP contribution limits, just get a hold of your notice of assessment. It's called an NOA, and that will have your RSP limits. Next up, we have the TFSA, the tax-free savings account, which I feel it's probably one of the most underutilized tool. Why? Because it has the word savings. What if we just take this out and we put an R there? It's a tax-free retirement account. This is not a savings account. It's not a savings account. This should not be used as an emergency fund. This should not be used to fund your trips. This is a legit investment vehicle that you can compound your growth tax-free for retirement, right? So I want everyone to keep in mind, these are just envelopes that you can put your money in. Because I hear people say, well, my TFSA doesn't do as well as my RSP. I think it's the banks to blame for that, because majority of banks, they'll just put you in a cash account getting 0.0%, 0.03, right? And we did the rule of 72. So we can technically know how long it would take for your money to double, right? So these are envelopes that you could put your money in. You can get 6% in any of these vehicles here. I can put you in the exact same portfolio in every one of these vehicles, the exact same portfolio. I can literally mirror it. How do you want to get taxed? Okay. So hopefully that makes sense. Okay. Please use your TFSA for retirement. Okay. You want to do your trips, you want to have your emergency funds, just set it aside. Have an automatic e-transfer that just goes into your savings account. Let that build up. Okay. Leave the TFSA and your RSPs alone. Benefits is it all grows tax-free. You contribute with after-tax dollars. You do not get a deduction, but then it grows in there tax-free. Okay. All that compound growth. The contributions are $7,000 a year. However, you get to backdate it to when you were 18 years of age. So the account came out in 2009. So if you were 18 years of age in 2009, and in 2026 rolls around, if you have no TFSA room or no TFSAs at all, you could put $109,000 in there. Okay. And then you'd be maxed out. So for 2026, it's going to be an extra $7,000. Okay. If you take money out of your TFSA, you will get it back the next calendar year. If you take it out of your RSP, you'll have to pay taxes and you will never get that contribution room back. Okay. So TFSA very flexible. RSP is not flexible. Now we have the first home savings account. Okay. This is a new account. This is how it works. It is the benefits of the RRSP. You get the tax deduction and then it's tax-free on the way out. Okay. When you do buy your first house. Okay. So it's $8,000 a year to and then your maximum would be to $40,000 of contribution. And I'll give you a tip, okay? If you do not have a first home savings account and one of your goals is to buy your first home, open it up this year. Even if you aren't planning on making any contributions. Why? Because you get to carry forward that room. So then in 2026, you'll have $16,000. You get a bigger tax break and you can have more money to put down on your first house. You can also use your RRSP. It's called the first time home buyer, where you can take out $60,000. Okay. You have to pay it back within a 15-year period. So you have to pay it back. The first home savings account, you don't pay it back. Okay. And then we have permanent life insurance. I'm just going to clear this. You do have to qualify because this is insurance, but technically you can tax shelter your money in here. Okay. So there's only 4 buckets or envelopes where the government will not tax us. What's one? We talked about it, the TFSA. Okay. Essentially, now we have the first home savings account, but the TFSA, the government will not tax you. Your primary residence, the government will not tax you. Your primary. The lottery is where the government will not tax you. And the only other tool that we can use is permanent life insurance. Okay. You get to use, if you ever need access to cash, it's in there. Okay. Now, you can use it as collateral for a loan, and that will bypass the taxes. Okay. People always say, Al, why doesn't the government put their hands on this? Because a lot of business owners, a lot of people will put a lot of money when it comes to these into a permanent life insurance policy. It's because the Dominion's Insurance Act came out before the Income Tax Act. Okay. It came out in like the 1860s, and the the Income Tax Act came out in 1917 to fund the First World War. Okay. Now, clear this. For the people that are just starting off, they're building families, all that good jazz. We always typically hear that, hey, once you buy a house, let's put money in your RSP because that's for retirement, and then put the rest in a savings account, right? That's what I was told. Well, why don't we do this? Why don't we lock in our insurability and we build a very good, strong foundation? Okay. And let's, again, lock in our insurability and let's start paying these tax rates first. If you want to buy your first house, again, we'll start over here and we will start maxing out your tax-free savings account. And then when you're in a tax bracket that can benefit, let's say north of 70 to 80 grand a year, maybe if, let's say the military people on the call, maybe you're a private, maybe we shouldn't be using RSPs until you're a master corporal or a sergeant. Because those contribution rooms will carry forward in an RSP. What if you're a first level or a second level apprentice? Maybe we shouldn't be using RSPs till you're a fourth level or you get your journeyman, right? Do you have a pension? Maybe we should just use TFSAs then, right? And then when we're in a tax bracket that can benefit, then we can take money from the TFSA. Let's put it in the RSP so that we get a larger tax deduction. And then what should we do with that tax deduction? Let's just start reinvesting it, right? But what do people do? They spend it. They spend it. Okay, so let's start double dipping our money, right? Most people, they will go on a vacation. They will typically spend it, okay? What people should do is, I don't mind paying off debts. I don't mind building your emergency fund. Maybe you have a reno. You want to do a reno on your house or reinvesting it, okay? For the people that are on the call that are essentially and going to be preparing for the decumulation phase of the retirement, right? A lot of moving parts. Essentially, is what I like to do is something called the RRSP meltdown strategy. Okay. What are we going to do? We're going to start melting down these RRSPs. Why? Well, a lot of people don't know, but if you were to pass away um, with our RSPs, the government's going to take half if you're not married. If you are married, it will be a spousal rollover tax free to your spouse. But essentially, if something happens to you guys at the same time, the government's going to take half. I don't know, for those of you on the call, you can simply look it up. Just look up the $660,000 tax bill that this family had to pay out in Southern Ontario. Why? Basically, what happened was uh, the the wife, I believe she had a critical illness and passed away. And then about 3 or 4 months later, the husband passed away um, due to a broken heart. And they had a cabin. So she's has half a million. That rolls over to his RSP. Now he has a million, and then he passes away in the same year. $500,000 goes to the government, and then they had a cabin, which they got to pay capital gains on. So the kids are trying to grieve, and CRA comes knocking with a $660,000 tax bill. And this could be solved pretty easy. It's very simplistic financial planning. Let's draw down the RSPs and let's start putting it in these vehicles so it can grow tax-free. Let's pay a little bit now to save a lot more in the future, or else we're just going to pay it later. Okay. And then essentially all this couple had to do is let's put a life insurance policy on themselves. So then if anything did happen, right, the life insurance policy would then be used to pay for the taxes on the RSP. And then that way, the kids could have netted, they could have preserved their entire estate. Okay. So that's more of like making the decumulation phase more tax efficient and prioritizing someone's estate. Okay. Because unfortunately, yes, the government taxes you when you make it. They tax you when you spend it. They tax you when you invest it. And unfortunately, they do tax you when you pass away. Okay. Now, setting up kids for the future. I know that we have a lot of people on the call that are building families, right? So how can we set kids up for the future? Number one is we have the RESP. This is the Registered Educational Savings Plan. And essentially, the biggest benefit in this is that if you want to save for your child's education, whatever you put in, the government is going to match you 20%. I don't know a lot of vehicles out there that it's going to guarantee you 20%. Guarantee it. And then whatever it earns in the markets on top of that. So it is called the Canadian Education Savings Grant. And then for families that qualify as low income, then you can also get the Canada Learning Bond. People always ask, well, what about taxes on the way out? Well, when your kid's going to school, it would be taxed at the child's tax bracket. And essentially, they'd be in school. Okay. And as the maximums, $2,500 a year, the government will give you $500. Okay. If you miss out on a year, it's all good. You get to backdate it 1 year at a time. Okay. Now, for an example, if someone's putting in $2,500 a year when the child's 18 at a 5% rate of return, this individual would have about $89,000 for their kid's education. If they did $100 a month for 18 years at a 5%, then this family would have essentially about $42,000 for their child to go to school, and there would be about $4,300 just in grant money that can go to the child's education. There is also the Registered Disability Savings Plan. This can work for adults and this can work for children too. It was introduced in 2008, and I believe it is probably the most powerful tool the government has to offer, and probably again the one that is the most underutilized. Why? I believe it's because it's complex. There's a lot of moving parts. I think it's because it's very new. It came out in 2008. And I do believe that once people know about the grants, they probably think it's too good to be true. Okay. So if you have a disability, mental or physical, try to qualify for the disability tax credit. Okay. If your family income is below $114,750 in 2025, the first $500 that you contribute, okay, they're going to match you 300%. So they're just going to give you $1,500. Okay. The next $1,000 that you contribute, they will match you 200%. Okay. So they're just going to give you $2,000. So contributing $1,500 in the year, the government's going to give you $3,500. Okay. If your family income is below that threshold, then it's a 1-to-1. You put in $100, they'll match you $100. Okay. And then it's whatever that you earn in the market. Question for an RDSP is do you get a tax deduction? You do not. Okay. You don't get a tax deduction. The annual and lifetime limits. So annual maximum grants, $3,500. The lifetime maximum grant is $70,000. When you factor the bonds on top of that, it's another $20,000. So it's $90,000 from the government that's up for grabs. And then the lifetime contribution is $200,000. Okay. Any questions on that? Feel free to let me know. I think another thing that not a lot of advisors would bring up is locking in your kids' insurability. Okay, no one wants to talk about their child pass away and being able to benefit from that, but it's not about that. It's essentially locking in their insurability to set them up for the future. Okay, so for $25 a month, you can put permanent life insurance on your child that they would have that for the rest of their lives. When they're 27 years old, they're going to automatically qualify for $500,000 of life insurance with no need of a medical and $25,000 of critical illness. And for those of you that do know me, when I was going to high school in Fort Frances, I was diagnosed with meningitis, and that's a critical illness payout. And I don't think family really understand the financial burdens when a child has a critical illness. My mom took all of her holidays. My dad took all of his holidays. Hotel parking is not cheap. It's gas, it's hotels, it's dining out, right? And then what essentially happened was they ran through all their holidays. So then my aunt from Winnipeg drove to Fort Frances, took all of her holidays to be a caregiver for me, right? So that $25,000 would have went a long ways. And then my brother, for those of you that know my brother, at 21, he got diagnosed with type 1 diabetes, which is a critical illness for kids. So, and now, since he didn't get a life insurance policy when he was healthy, he now has to pay 3 times the amount. And unfortunately, because he's got type 1 diabetes, his kids or my nieces don't qualify for critical illness. Okay, so it's just setting them up for the future, right? And then essentially letting them run after that. Okay. Now, calculating your life insurance need. Again, we rely on our stuff through work, but how do you even calculate your life insurance need? It's pretty simple. You're just going to do the dime method. Okay, you calculate your debts, calculate income replacement. That's usually between 10 to 20 times. I would say it's based on how old your kids are. Okay, we're going to pay off the mortgage, and then we're going to throw some extras in there. That's education for the kids. That would be probate taxes if you are not living in Manitoba. There's charity, there's taxes, all that good jazz. Okay, so as an example, if someone's making 80 grand a year, let's say they have $25,000 in car payments, lines of credits, they're earning that 80 grand. So for 15 years, they want to protect that income for 15 years. If something happened, then the spouse would get $1.2 million that he or she could use to raise the kids. The mortgage would be paid off and the kids' education would be paid for. Okay. And that need would be about 1.67 million. If someone has 100,000 through work, you can see the shortfall. Okay. And just for everyone to know, a 30-year-old male non-smoker is $55 a month for $1.5 million of life insurance. For $1 million, it's $38.50. A female, 1.5 million non-smoker, $36.85. And for $1 million, it's $26 a month. Doesn't have to be expensive. Okay. Can be pretty affordable. And unfortunately, 8 days ago, today's Thursday, so not the last Wednesday, the Wednesday before that, unfortunately, I did have a client call me. It was like 10 o'clock in the morning and told me that her husband passed away in his sleep. Okay. And there was only two questions she asked me was, how much is the check and when can I get it? And based on the stories that I heard, I don't think that I've ever heard of someone that wished they would have applied for less. They always wish they would have applied for more. And I have another client that said no to a critical illness policy. And then 2 years later, he got diagnosed with stage 4 prostate cancer. And unfortunately, um, he cannot take his disability through work because he was working so much overtime to pay his bills. He cannot take it because it will not pay him enough. So he's going to be working till the day he passes away. Okay. So just to let everyone know on this call, because I hear these objections quite a bit, please do not rely on your parents. Do not rely on your boss to protect your family, and please don't rely on the government. Okay. Um, Again, most Canadians are playing with a pulled goalie when it comes to their finance. Okay. One turnover can basically just cost you the game. I see it all the time. And guess what? I was there 7 years ago. I didn't know I needed any of this stuff. I didn't know any of it. But now, since I've been here for 6 or 7 years, I hear these stories all the time. Okay. There's two different types of life insurance. One is term and one is permanent life insurance. Okay. Now, what is term insurance? I want you to think of it like renting. It's basically just like your house insurance, just like your car insurance. Okay. And that's what I find pretty unique too, is we have insurance on our cars, we have insurance on our house, we even have insurance on our phones, but we don't have any when it comes to our income. Okay. So term is like rent, and permanent, think of it that you're going to be owning it now. Okay. Term is very affordable. Like, as you said, I just gave you some examples. Where permanent, it is going to be more money because you have it for the rest of your life and there's money back. Okay. With term, it can expire. It might be a term 10, so it'll be level for those 10 years. It might be level for 20 years. Okay. And there's no money back. But here's the best thing about term, because I give a lot of term to my clients because it's so affordable. You can take term and you can change it or exchange it into permanent without the need of a medical. So I know permanent sounds good, but you might not be in the situation to afford it. So let's get you the right amount for a very affordable price, and then you can just exchange it along the way, right? Maybe you pay off the house. Maybe the kids move out of the house. Maybe you pay off your car. Maybe you have some more cash flow. We locked in our insurability. Okay. For critical illness, it is a tax-free lump sum. How disability pays you monthly, this is just a one-time lump sum check. Okay. Essentially, what people do is if you had maybe a couple years to live, you can use that money to go nail off your bucket list. If potentially there's a situation where Canada Health or our healthcare system doesn't offer, you can take that money and go down to Mexico or go down to the States and use that money, right? And the average effective rate is 1 to 3 times of annual income. And then there's disability protection, right? What is that? If you had a money printer machine that was in your basement printing you out 80 grand a year, would you put insurance on that? Of course we would, right? But we are that money printer machine and we can break down from time to time. And from RBC Insurance, the average claim is 3 to 4 years. So if that happened to you, what are we going to do to make sure that we can still pay your bills? Okay, so the effective rate is about 70% of your gross income. Okay. Now, when you're buying a home, I talked about the mortgage insurance. Okay. There's a better alternative. Let's get the life insurance instead. Why? Well, because with mortgage insurance, you're paying off the balance of your mortgage, right? So you're paying for declining coverage, where life insurance can stay level. Okay. The next one is that unfortunately the bank is the owner and the bank is the beneficiary when it comes to mortgage insurance. Okay. where you get to choose. You can own it, and I'm sure you list your spouse or your kids as the beneficiary. Okay. It's there's not a lot of convertibility options, so it's not that flexible. And the biggest thing is that it's post-claim underwriting. What does that mean? What does post-claim underwriting mean? It means that they're going to look at doing the review process to see if you're healthy at time of claim. How are we going to know if we're going to be healthy in our 40s and 50s? We don't. So that's why there's a higher chance of them denying the claim. Or with life insurance, they do all that review process at the time we submit the application. So if you're approved in like 2 weeks or a month and something happens to you 20 years down the road, you've already been pre-approved. Okay. And for most people, I probably replace mortgage insurance once or twice a month because the banks have to give it to you to check off the box when it comes to compliance. And the people at the bank, they don't have an insurance license, so they have to offer that, check off the box to compliance. So just look out for that. Okay. OAS and CPP needs to know is there's Canada Pension Plan. What is this? This is what we can use to supplement our retirement. So you can see the average payout for CPP right now is about $899 that is taxable. Okay. For people that say, well, that's not that much, because you look at OAS, they'll give you another, the maximums right now are $740. I can't live off of that. I understand that. It's there to supplement your income. You're supposed to get yourself to retirement. Okay. Now, CPP is based on how much that you've contributed, when OAS is how long have you been living in Canada. So if you've been living and working in Canada for 40 years, you would qualify for the maximum. Okay. Some mistakes that I see when it comes to CPP is taking it too early. A lot of people will say, well, I don't know when I'm going to be passing away, so I'm just going to take it now. Not knowing that if you take it at 60, recommended you take it at 65, you would be taking a 36% pay cut in the benefit. Okay. If you do wait until age 70, so don't even take it at 65, extend it till age 70, you get a 42% enhancement in the benefit. Okay. And I want to talk about both sides. When would you take CPP early though? Right? You need the cash flow. You do have potential health risks, and you could be open for OAS clawback. Okay. What is that? Essentially what the government does is they say, hey, if you have too strong of an income coming in for retirement, if you have more than $91,000 of income, we're going to claw you back OAS. So for every dollar that you go over, we're going to claw you back 15 cents. So essentially, it's a double tax. Okay. So there's some planning that needs to be going on there, because if we pay this much in tax, we should be making sure that we can earn the entire benefit. It might be hard to generate income right now, but it can be certainly very easy to minimize income. Okay. You can live on cash. You can use your TFSA. It's not deemed as income, that kind of stuff. Okay. You can leverage the permanent life insurance policy, all this stuff. Okay. For people that say, I don't know how long I'm going to be living for, I'm just going to take it now. I get that. 35 years ago, 200 years ago, the life expectancy was 35. And 100 years ago, life expectancy was 65. Okay. So if you don't know much about this, like financial planning, it's all good. I didn't know anything about it either. Retirement concepts, fairly new. People just died at 65 100 years ago. Okay. So with modern medicine, it's not going to be rare that people start living in their hundreds. So if you're 65, the statistics are showing that if you're a male, you'll be living till 84. And if you're a woman, you would be living till 87. And only 2% of Canadians will delay their OAS and CPP. The cost of waiting, so we might have some young bucks on here that said, you know what, I'm good. I don't need to save for retirement. Right? I'll come back in 5 years. Sweet. So let's say you're 30 years old and you're going to start doing $250 into a TFSA. Boom. You're going to do it till you're 65 at an 8% rate of return. If you do this, you would have almost $1.2 million tax free. Tax free. This is in your pocket, right? This is not an RSP. This is a TFSA. But you're good, right? You're young. I'll come see you in 5 years. Okay. I don't know if people would know, but to do that, it would cost you about $400,000 to make that decision if you wanted to come back in 5 years. Okay. So if you guys are taking notes, guys and gals, write this down. These are 3 money behaviors to adopt. Number 1, focus on your own goals, right? Don't worry about what other people are doing. Okay. Like I mentioned before, we are keeping up with the Joneses. Number 2, save your money and live below your means. Okay. Pay yourself first. And number 3, invest your money and be patient. Okay. That is a kindergarten list of topics that I gave you. And if you listen to these, you would most likely be in the 1% of Canada. Okay. It's not a bunch of formulas. It's not a bunch of gibberish that you're going to hear on Wall Street. And I do think that we need to start redefining the definition of financial success, because it's not about owning private islands and driving the nice fancy car. Okay. It's not about that. I think majority of Canadians, what we really want is we want some stable housing for ourselves and our family, right? We're gonna want to be having a little bit of a cushion. So if we have a layoff or if we have a medical emergency, it's there. We can just cut the check because we have the cash. You don't have to worry about it, right? I'm sure that we want to be able to retire someday and know that we get to work. We don't have to work, right? Um, And keep in mind, if you have a pension, we all know what has happened to Sears, Safeway. If you're from Fort Frances on the call, we all know what happened to the paper mill, right? Owners can come in, buy it, and reduce the pension. So money cannot buy you happiness. I understand that, but essentially it is a tool. And if you use this tool efficiently, you can spend more time with your kids and with your grandkids. Okay. And these are really, really good financial goals that you can have. Okay. I do want to thank everyone for coming on here. How long was that, by the way? Okay. It's 54 minutes. So I know that we started 2 minutes late. So I want to appreciate everyone coming on here. I want to ask you, what did you find most interesting? Okay. Do you think Canadians are using these financial concepts and strategies to the best of their ability? Um, I'm sure that I'm sure we get a checkup from the doctor done every now and then. When's the last time that we had a financial checkup done? Right. I want to thank you all for attending. If you guys can please, and gals, please send me an email, a text message, give me a call, give me some feedback. Okay. I would love to keep doing these every 6 months. And I would love for one day where money isn't such a touchy subject, right? I do have a QR code there, so if you would like to have a visit with me and see what a financial plan would look like for yourself, it will bring you over to my Calendly link. You can book yourselves in there. And if you were on this call, I will waive my planning fee. Okay, so I'll essentially provide you a financial plan that talks about all the stuff that we talked about. Essentially now there's a Q&A. So Matt, do we have any questions?
We do have one question. This person's been sitting rather patiently. It goes back to your foundation slide, Alan. And the question was, what do you mean by you will not be taxed on the primary residence? Is it on the sale or on renting a portion out or something else?
Good question. Okay. So yes, when you sell, if you um, sell your primary residence, the equity is not taxed. Okay. So if that's a rental property, then you would have to pay capital gains tax. So as long as it's your primary residence, you will not be taxed. And that's what a lot of Canadians will bank on when it comes to their retirement. Okay.
What
Any
about like when you talk about saving, Alan, like when can somebody stop being like more on the frugal side and start spending some of what they have saved?
um I would say that based on the people that I have known in this industry or based on wealthy people that I know, I meet a lot of people that it looks like they have a lot of money. They drive the nice fancy car, they have a nice suit, and then you find out they're in debt. And then you play with a guy that just wears the same white t-shirt, golf shirt every time you see him, and he's got millions of dollars in the bank. So when can we start spending that money? I would say is that let the stock market fund things, right? If you have $1 million and you're earning 6% on that, that's 60 grand a year. You want to go buy your nice car? You want to go and buy your nice watch? Live off the interest. Don't touch your principal. But again, it's delayed gratification. And in the world that we're living in, everything's right now. Okay.
A couple more questions coming in, and they're both related to RESPs. So, first question is actually, looks like it's similar questions, but we'll start with what happens to the funds in the RESP if your kids don't end up using all of it or they decide they don't want to continue education?
That is a great question. Okay, great question. All right. So essentially, yes, if you look at the statistics, kids drop out, they say, oh, this ain't for me, they go get a job, right? What do we do with those RESPs? Um, the contributions that you've made will come back to you tax-free. Okay. The growth of the account would go to an RRSP. Okay. And the government would take their grants back. That's why if there are advisors on the call too, because I know a couple advisors want to jump in. When you are taking money out of the RESP, make sure you take the government grant money first. Because if the kid or the child decides that it's not for them, well, the client is going to have their contributions in the growth still. Okay.
Somewhat related with the RESP, can it be used for something indirectly related to education like food, housing, or transportation?
Good question. So yes, it's quite broad. Okay. So essentially all you would need to, like in my experience, is you can use the RESP to, if you're coming in from out of town and you need to pay for, you're going to be staying at U of M for a bit, right? You need food, you need rent, stuff like that. And all that and I would say too, is they've really broadened their scope. Like you used to not be able to use an RESP for hair school or trades college. So they've really broadened it. Okay. Um, and you just need to provide the certificate that you are going to school and that you've been approved. And then essentially is that we could take money out of there. So yes, food, rent, yes, that stuff can be covered.
And it looks like we've got time for at least one more here. So you mentioned when you were talking about double dipping and
Yeah.
moving your money between RRSPs and your TFSA. Can you
Yeah.
talk more about that?
Okay. So let's say you're in a high tax bracket. Okay. When you put money in an RRSP, you are going to get a tax receipt. Okay. So you're going to get a tax receipt that you're going to be able to provide to the government, or sorry, provide to your accountant. Okay. And when your accountant provides you like T4s and all the other tax returns, it will let you know whether you've get a refund or not. Okay. So when you're an employee, you get paid, you pay your taxes, and then you spend whatever's left. Okay. And the government is essentially telling us that we aren't disciplined enough. So they're going to take the taxes off, um, whether you like it or not. So essentially, did you underpay or did you overpay? If you overpaid, then you will get a refund. Okay. That's why making that contribution to the RSP, you're saving money on tax. And for majority of people, they get a refund. And when they get this refund, they get this check, you should either pay off debts, build your emergency fund, or reno in the house, right? Or you should be able to reinvest it. So hopefully that answers your question. If not, feel free to ask an accountant as well. Okay.
That looks like the Q&A, Alan.
Okay. Awesome. Yeah, thank you all for coming on. And if you have any questions, I have my email and the work phone is there. And I hope everyone has a great night. Thank you all for coming. Bye-bye.